The minutes of the Federal Open Market Committee's March meeting was released, giving investors a more detailed account of what took place. And the March meeting was important for the Fed. The committee removed its patience language from the statement, though the central bank still remains vague on when it will raise short-term interest rates. Here with more analysis is Michelle Meyer, Deputy Head of Economics at Bank of America Merrill Lynch. And Michelle, this is the minutes of the March meeting, well before last Friday's dismal jobs report. And we'll talk more about that in a moment. But first, your reaction to the minutes. I mean, the March meeting itself was rather significant, right?
It was. It was significant for a number of reasons. As you said, they removed their forward guidance. They took out the patient language. They also significantly revised down their forecasts for both inflation, but also the trajectory of interest rates of the Fed funds rate. So what we learned from this statement, and I think that was reinforced in the minutes, is that the Fed, although they want optionality to start hiking interest rates at some point in the near term, depending on the data, they do remain cautious. They do worry about downside risks, and they anticipate that it's going to be a gradual cycle. In the minutes, there was a little bit more emphasis on June as a possibility. Now that we got that weak jobs report and the flow of data just continues to come in pretty soft, expectations are probably shifting out. September seems like it's a more likely outcome. But I think the bottom line is that the Fed wants to have optionality. They want to have flexibility in terms of when to start that normalization process.
All right, now New York Federal Reserve Chairman William Dudley told Reuters today that a June liftoff was still, quote, in play. I mean, wouldn't hiking rates in June be seen as jumping the gun a bit too much given what happened last Friday?
My own view, yes, I do. I don't think that the current data warrants a higher rate environment, and I don't think it's appropriate to transition at this point from the exceptional period of accommodation. That said, I think the reason Fed officials are continuing to note that June is on the table is because they really want to reinforce this message to the markets that the Fed has flexibility. They are no longer guiding the markets in the sense that there's no forward guidance in their language. They don't have a dovish bias. They have a neutral bias. And they're telling the markets the next move will be a hike. Depending on how the data comes in, we will lift off at some point. We're going to go slow. We're going to be cautious. We don't want to derail the recovery, but we do think the economy can start experiencing higher rates at some point. Personal opinion, yes, June seems a little bit early. But I think probably before the end of the year, if the data looks healthier, the Fed's going to lift off.
All right, well, let's talk about that. I mean, the strengthening dollar is still part of this. I want to read a quote from the minutes. They said the effects of energy price declines and the dollar's appreciation would continue to weigh on inflation in the near term, suggesting that conditions likely would not be appropriate to begin raising rates until later in the year. Do you buy that?
I think there's concerns about that. There's a lot of difficulty trying to understand the magnitude of import price pass-through. So we all know, if you look at basic economic models, a stronger dollar means greater disinflationary pressure, and that will start to show up in the data. The lag is unclear, and the magnitude is unclear. So I think there's a real risk that perhaps we're all underappreciating how much this import price pass-through is going to weigh on inflation. And considering that the base we're starting on is very low, we're only running at 1.4% core PC inflation on a year-over-year basis. If you start to see this pass-through of import price declines and pass-through of oil price declines, it could make the trajectory into the end of the year that much lower for inflation, and I think that could push out rate hikes.
All right, Michelle Meyer, Deputy Head of U.S. Economics at Bank of America Merrill Lynch. Thanks for your time.
Thank you.
I'm Scott Gamm, and you're watching The Street.